Howdy there, folks. We got a very, very serious situation developing here around SVB Bank, and I thought I would react to a few videos in this one here today, okay? This is the makings of a bank run on SVB, says Hugh Sun. We'll react to that one there. Second video up here I want to react to Ava Labs Woo on SVB. This is a classic bank run on Bloomberg, so we'll react to that one here and see what's going on there. And then third video I want to react to has nothing to do with SVB. I just thought I would hear this gentleman's points he has to make, and my points actually might shock you in this one, considering Meta's my biggest position, but I might have a little different opinion actually than this gentleman. I'll hear his points out and then kind of share my points off of that. So we'll react to that one. SVB Bank, by the way, is down another 22% in after hours. We'll see where it trades at in the trading day tomorrow. You know, I mean, is it impossible to imagine that baby's under $10 in a matter of a few days? It's not. Okay, I'm not placing a bet. I'm not going to go there. It's not worth it. My risk. No. Okay, it's not worth it. But I will say this is a situation that's getting very, very ugly very, very quickly. So we'll hear what they have to say. By the way, we're only hours away from me making my next moves, buys and sells in the Patreon portfolio through Fidelity Investments. That's going to be pinned comment down there if you want to join us in there. That's a no-brainer to be part of that. I don't care if you've been in the market for a few days or you've been in for a few years. Like, you got to join us in there to see the moves I'm up to and exactly how I build a portfolio.
On what is becoming a bigger story by the hour, another big California-based bank facing really can't be called anything but an investor panic. Shares of Silicon Valley Bank. May not have heard of them. It's one of the oldest and biggest banks in California. It's not a traditional bank. It is focused primarily on tech and VC investors. The stock closed down today 60%. It is down another 28% after hours, meaning 24-hour decline, more than 70%. Now, yesterday...
No, if you didn't know, basically this bank, it's not just like your grandma's bank that, she's got $2,000 in a savings account or something or in a checking account. This bank has a lot of very high net worth founders of tech companies, money tied up in it. And, basically they're all pulling their money out left and right now, like yanking that money, right? Because your money's only, you got to remember this, right? And this is for anybody watching this, that you're either at a level where you got significant amounts of money in a bank account, or you're going to have someday that, right? Okay. And I got to explain this to everybody, because I don't think this hits a lot of people, and this is so important. Okay, your money is only FDIC insured to $250,000. Okay, now for probably most people watching this video right now, that's not a concern for you because you're going to have less than $250,000 in account. But for maybe the top 10% or 20% of people watching this video right now, there's a good probability you have over $250,000 in account, or you're going to have over $250,000 in account someday, okay? So you might just want to split that money apart in a few different places, because it is a huge, huge risk to you. Imagine you got $10 million with SVB over here. They go under. You know what you get? You get $250,000 of your $10 million. Oh, it was just in a savings account or a checking account. Doesn't matter. Doesn't matter if that baby goes under and the money's not there for whatever reason, okay? For whatever reason, the money's not there. The government's only backing you to 250. They're not giving you 10 mil. As much as you might want it, in good luck, and then you could try to do some sort of a lawsuit or something like that, and good luck with that. That's just going to eat up more of your money, and there's probably going to be no money there at the end of the day, okay? So this is a very significant situation going on here, and it's very, very serious.
Crypto-focused bank Silvergate Capital said it was shutting down, liquidating. So what exactly is going on with some of these big banks, particularly in California? It could be the sign of a bigger issue. CNBC reporter Hugh Sun joining us now. Hugh, again, maybe not a household name bank, but as we talked about with Deirdre Bosa, pretty darn important.
It's a household name in the startup world for sure. They've been around for 4 decades. And
yeah, that's the thing. Like, almost no one's heard of this unless you're from California. And I really mean like the VC space. Like, you talk to anybody in the VC space, they all know of this bank. It's almost like its own little whisper that is so important, and like hardly anybody knows about it, but the people that do know about it are usually filthy rich.
Played an instrumental role in the development of startup culture in this country. And that's why it's shocking that, there seems to be, the makings of a classic bank run in terms of concern and fear about the return of your money, Brian.
Yeah, and where does this go from here? There was an SEC filing. I don't want to go into the weeds too much. That a big other fund, General Atlantic Partners, well-known venture capital, looks like they took a $500 million stake yesterday, but clearly did not help today. I mean, how does this play out, Hugh? And in your reporting, because our viewers may not care about this one bank, is there any contagion risk here?
Well, it helps to back up a little bit, Ryan. So they raised about 2.3 billion in debt and equity today to shore up the hole that had developed in their balance sheet from people taking out money, founders obviously not raising money in the public market, so drawing down the reserves, and that put pressure on them. Plus, an ill-timed bet.
To put into reference how serious this is, okay, and I had some folks that contacted me about this and kind of put it on my agenda on how big of a deal it was, because I think they had seen my video, and I think they were like, hey, this is a bigger deal than you're kind of thinking here, okay. Even Peter Thiel, I'm reading to go 7 hours ago, Peter Thiel, Founders Fund advises companies to withdraw money from SVB. Peter Thiel knows everything about everything, okay? And he knows everybody that's everyone. And so if that man's telling you, pull your flip and flapjack and money out, it's a serious situation. Extremely, extremely serious. He knows, I'm assuming that he must be worried that they're about to go under if Peter Thiel's doing that, right?
On some bonds at low payouts. Now, my understanding is that, from the people I've talked to, there's going to be additional pressure because of the action today. And we don't know the extent of that, a small sample size, but I've talked to people who've taken out half of their deposits. I'm talking about tens of millions of dollars in VC money that they've raised, that they parked at Silicon Valley Bank.
Exactly. It's not like this is small amounts of money. Like I said earlier, with your grandma's got $2,000 in a savings account somewhere or something like that. This is crazy amounts of money. I'm talking about founders moving, millions, tens of millions, maybe even 9 figures plus out of this. This is crazy bank run. Now, you want to talk about systemic risk, okay? There's 2 levels of systemic risk that are extremely serious here. The first level is that, potentially them being intertwined with other banks out there, other funds, and those potentially maybe going kaboom as well, okay? But the second part, and I think this is even more significant, is if some of these companies have money tied up there, they can't get to it. Those companies then have to try to raise money from somebody else. If they can't raise that money, they go under, right? We know Silicon Valley, we know that whole tech situation over there. Most of those companies aren't profitable, and most of them are losing crazy amounts of money, and every 3 to 12 months, they have to raise money. And if they don't raise money, they don't make it. If they don't raise the money, they don't make it, and literally that's the end of it, okay? So this is why this is so significant on multiple fronts here.
That because of the concern that they won't be able to get it out later. So this is really a concern. Nobody knows where it ends. We shouldn't feed into the concern and fear, however, and just report on it. It's safe to say that there is the makings of a potential run on the bank.
Well, there clearly is. I mean, I don't think we're doing anything wrong. Houston, we got to go. Thank you. Throw the stock chart back up, guys. Down 60% today. It's down 26% right now. It actually sold off more after hours. Lately, Peter Thiel reportedly telling people to get out. It's a big story. We're continuing to monitor it. Head over to CNBC.com for Hugh's latest reporting as well. I doubt Hugh's going to get a lot of sleep tonight.
All right, next one up here from Wu on SVB.
Is, of course, at the same time as we worry about Silvergate's implications, we think about what's happening with Silicon Valley Bank at the moment, its exposure to technology, to startups. John, just want to bring our audience some breaking news that, interestingly, the Founders Fund, which a key VC player, is advising that its own companies should withdraw funds from Silicon Valley Bank. Now, we know the CEO of Silicon Valley Bank has been out there trying to reassure clients as to what the stock drop means, what the conservation of its capital at the moment is trying to signify. But ultimately, we are going to see some concerns being built if Founders Fund are indeed advising their own portfolio companies to withdraw funds from SVB. Can I ask you, as a founder, John, do you have money in traditional finance? Do you have money with Silicon Valley Bank?
Well, Silicon Valley Bank is one of the banks that we use, as well as some of the other ones that were mentioned. So I think the right thing, the prudent thing we've learned is counterparty risk once these things start. This is a classic bank run. And when the bank run starts, you don't want to be the last guy there and wondering what happened. Unfortunately, this is the way banks work. They rely on trust. When they lose that trust, bad things really will happen.
So basically, what it sounds like that gentleman just said right there is it sounds like he just pulled a bunch of money out of there. Like, literally read the tea tree leaves there. It basically sounds like that man just pulled a bunch of money out as well.
And so I know we have so much to discuss about Ava and what's happening with Avalanche, but we have to stick with this story because it's happening before our eyes. What do you do in this situation? Do you follow the advice of names in the Valley like Founders Fund and pull the money? Do you stick with it? I mean, I have to just point out, there were a number of names that Bloomberg cited in its reporting that said what we're seeing in Silicon Valley Bank is not the same as Silvergate, and actually long term they have a completely solid future. What would you do in this circumstance?
Well, hopefully there's enough. What I would do is you have to diversify out and maybe not pull everything, but pull some.
Have you,
we
John?
experienced this back in the great financial crisis where you had to diversify your prime brokers. Luckily, we have already diversified, so we're less exposed than we were literally just a few weeks or months ago.
Okay, and I think ultimately you're going to continue to dig, to ask questions. Has it been easy to gain that sort of information from Silicon Valley Bank at the moment, or are you relying on analyst reports that we get and indeed some of the reporting coming from our own journalists?
You're relying on your own interactions. The operator always has a better view. The cadence of responses and how things are working, the size of transactions, all of those little subtle hints is what we're relying on as an operator. By the time you read it in the news or something, unfortunately, it's probably a little bit late.
Okay, man, that guy felt like he was withholding a lot of information. Felt like he was withholding a lot of information there. What it sounded like to me is this man might have knew something was already up, so he was already pulling money. Did you hear him say we were not nearly as exposed as we were a few weeks or a month ago, right? Sounds like that man knew something, and it also sounds like he might be pulling already. So there was a strange gentleman there, okay? I'll put it like that. It seemed like he was just withholding a lot. And I don't know, maybe he didn't intend for it to be like that, but I mean, just based upon what I just watched there, it seemed like that man was withholding information. Let's just call it that, okay? Next one up here is on a meta stock here. Just to finish out my thoughts on this whole situation is extremely serious. I think I would call it right now a 50-50 if that baby's even around in a few weeks from now. Like, literally, that's how freaky it is for that whole situation. It's like a 50-50, and that's crazy to think, like, just a matter of a few months ago, it was perfectly fine, and now for it to be at a situation where it's a 50-50, it's a coin flip, if they will even be around in a few weeks, it's extremely serious. But I'm telling you, with them already having issues, financial issues, and then you've got all these people all of a sudden pulling out millions, tens of millions, maybe hundreds of millions of dollars, and it's like, everybody there, right? There's pure panic. It's a straight up bank run. Like, this is the type of stuff you saw in like the Great Depression, right? Like, that's just crazy to even think that's going on. But this is, once again, this isn't really a traditional bank. This is no J.P. Morgan Chase. This is no Wells Fargo or Bank of America or anything like that, right? They called themselves Silicon Valley Bank, but when you look into what they were up to, what they were doing, it's like, is this really a bank? It doesn't really seem like much of a bank, other than a lot of high net worth individuals in the tech field might hold money there either for their companies or for themselves. But I can tell you, it didn't feel like a traditional bank by any stretch of the imagination. Okay, last video up here to react to is this one on Meta and tech stocks in general, and I might have a different opinion. We'll see.
Look, interest rate spikes last year, unprecedented interest rate spikes last year, just demolished the tech sector, NASDAQ, and in the consumer internet space that I looked at, which traded off 55%. I don't think you're going to get that kind of shock this year. And frankly, what you've seen so far this year is consumer internet outperformance. But, interest rates, the sector, anybody with long duration assets, future profitability, always very sensitive to interest rate changes.
Now, is there another shoe to drop in this economy, perhaps, for these companies that you cover? Is there kind of a Banks type moment that we had today? Now, granted, this wasn't too bad for the banks compared to what internet has been through. But these economic headwinds, has internet largely taken its lumps already, do you think?
Well, they've certainly taken lumps. And from a stock picker's perspective, look, what we focus on is that multiples have been de-risked. We're close to trough multiples. Actually, we are at trough multiples for most of the internet names. estimates have been de-risked. We just finished the December quarter. The prints finally rolled through in the last couple of weeks. It's the first time in a year and a half we've actually had, as a whole, upwards estimates revisions rather than pretty substantial downwards estimates revisions. There's no question that the estimates can always still further come down. But the one thing that helps a lot of these companies is all the cost actions, all the RIFs. Those are always unfortunate. They're always painful when they occur. But in some of these companies, they were clearly necessary, and they kind of help protect that earnings. And so I think that the downside to earnings risk is much less at this point than it's been at any point in the last 12 months.
Speaking of reductions in force,
I agree with that. Very low expectations. That's one of the great things. Let's say the S&P 500 companies, NASDAQ 100 type companies have, even small cap companies, low expectations. I mean, very, very low expectations because of all the concerns, because of all the worries about recessions, about this, about that, about troubling numbers that have been coming in over the past, let's call it several quarters now, right? Obviously, Fed still raising, worries about inflation. All that's leading to a very conservative outlook in terms of companies and their earnings. And ultimately, that's a good thing for stocks because now it's like you don't have to come in with a lot to impress, right? When your expectations are through the roof, it gets hard to even impress in any significant way, right? Now some of these companies have these expectations that are kind of on the floor, and all they need to do is report a little better than expected. And what do they see? Huge pop. I think Meta is a perfect example, and we'll see if this gentleman, what his opinion is on Meta. I think that's a perfect example, right? That company just, their estimates got pushed down so low that when they came out and it was okay, it was like, oh, there we go, big pop. Tesla, another good example of that. Nvidia, another good example of that. Netflix, another good example of that. Some of those stocks just get way oversold to the downside, and then you don't need much to push it up on the other side.
Layoffs and discipline. Meta has moved from your number 3 net large cap pick to number 1. Why?
Well, in part because it looks like we're going to have more cost actions taking place. Zuckerberg called this the year of efficiency. I think he largely was tracking that way last year. And then we had this blip around the September quarter earnings when he decided that he wasn't going to slow down expenses, and then 2 weeks later changed his mind and said he was. But I think most of the signals have been this company's going to operate more leanly, and there's plenty of opportunity for them to do that. But in addition to that, I think this Reels rollout that's just been in place for well over 12 months. I think it's actually starting to really come in positively for the company. It's driving higher users, higher engagement levels, and they're starting to close the monetization gap. So it's
in terms of Reels, I've been talking about that for quite some time on the channel, right? Quite some time. And obviously Meta is the biggest position I have in the public account, for example, right? Stock matters to me just as much, if not more, than any other stock I possibly hold. When it comes to Meta, is this the number one big tech stock to be buying in 2023? My opinion on that is no. I believe it actually is Amazon for 2023. I believe Meta stock was the number one stock to be buying in 2022, especially in the back half of this year, back half of the year when that stock was just crashing 150, 120, under $100, right? At the lows, it was down to $88. I think last year was really that crazy opportunity. I think Meta's still stealing money at this point in time, but I wouldn't put it as number one. Right now, I would put Amazon as number one over Meta right now. Probably number 3. Oh boy, that's close. It would be between Shopify and Tesla right now for that number 3 position there.
Another reason you're going to have revenue growth acceleration in this name in the back half of the year. And then finally, the ad targeting, the ad attribution model at Facebook, at Meta, was severely challenged by the Apple privacy changes. But we're now well beyond a year, 18 months into that. And we're seeing the company, based on our channel checks, get better and better with the ad attribution models, which means the return on ad spend is rising, which means there's another reason why advertisers are going to start coming back and spending more of their dollars with Facebook, with Instagram. So there's just a couple of things that are working, bringing down costs, and I think you're going to get this acceleration in revenue growth. It's trading at 14 times earnings. I think there's 50% upside in the stock between now and the end of the year.
Wow.
That's beautiful. And when it comes to Meta, like you spoke about there, efficiency. I mean, the net income should blast higher over the next few years, EPS as well, right? And at the end of the day, if you need to advertise for a business, the number 1 and number 2 places you still got to advertise all these years later, Facebook and Instagram. Then after that, everything else comes after that. I appreciate everybody joining me as always. 24,200 plus subscribers, if not 24,300 subscribers now. I appreciate each and every one of you that subscribe to the channel. Also, thank you everybody that supports the channel on Patreon. You get in there ASAP. I'm about to post the new moves I'm going to make in there, so you get to see access to that each and every week, all the moves I'm making, and get to track the portfolio over time. I appreciate y'all. Much love and have a great day.